Hey everyone, and welcome. Today we're going to dive into one of the most popular and honestly one of the most misunderstood tools in trading, the Relative Strength Index, or RSI. We're going to look past the super basic stuff and see what this indicator is really telling us about market momentum. Let's get right into it.
You've seen it, right? That squiggly line at the bottom of a stock chart. You've probably looked at it and just thought, what in the world is that? Well, it might look kind of random, but it's actually telling a very specific story about a stock's momentum. And today, we're going to learn how to read that story.
All right, so first things first, what exactly are we even looking at here? Let's pull back the curtain on this thing called the Relative Strength Index. Think of it like this. The RSI is basically a momentum meter for a stock, or any asset. All it does is measure how fast and how big the price moves are. It does this by looking at the average gains on the up days and comparing them to the average losses on the down days, and it spits out one single, powerful number that helps us see if a stock has gone too far, too fast.
And, this tool isn't new. Not at all. It was introduced way back in 1978 by a guy named J. Wells Wilder Jr. What started as something traders had to calculate by hand it just blew up in the 80s when charting software became a thing for regular folks like us. Now it's so common, it's even built into super smart automated trading algorithms.
And what's so great about the RSI is how simple it is on the surface. Everything it's measuring, it gets boiled down into this one simple scale that just moves back and forth between 0 and 100. That's it. And on that scale, there are a couple of really crucial levels that are the foundation for how most people use it.
Okay, so that brings us to the most common way people use the RSI, trying to spot when something might be overbought or oversold. Let's break down what those fancy words actually mean.
Okay, key level number 1, the number 70. When you see the RSI line climb above 70, that's the classic signal that an asset is overbought. It basically means the price has been shooting up and it might be due for a breather, maybe a little pullback. It's like the market's gotten a bit ahead of itself, a little too hyped up.
And on the flip side, of course, we have the number 30. When that RSI line dips below this level, it suggests the asset is oversold. This means there's been a ton of selling, and the price might be getting ready for a potential bounce back.
Okay, stop right there. This is a huge, huge trap that so many new traders fall into. You might be thinking, awesome, I'll just sell every time it goes above 70 and buy every time it goes below 30. But it is absolutely not that simple. See, in a really strong trend, a stock can stay overbought or oversold for a long, long time. You have to remember, context is everything. And this is exactly where that context comes into play. So check this out. When a stock is in a really strong uptrend, the RSI will often just hang out between 40 and 70. A dip down to 50 isn't a sell signal. It could actually be a great time to buy. And on the other hand, in a nasty downtrend, the RSI might never even get to 70. A little pop up to 50 or 60 could be your cue to get out. So you see, the so-called rules change completely depending on the bigger picture.
All right, so let's move past the basics, because there are way cooler, more advanced signals you can look for. And one of the most powerful ones is a concept called divergence. Divergence is all about when the price and the RSI start telling two different stories. For example, a bearish divergence is when the stock's price hits a brand new high, but at the same time, the RSI actually makes a lower high. That's a huge warning sign that the upward momentum is running out of gas. And the opposite is true for a bullish divergence. The price hits a new low, but the RSI makes a higher low. That's a clue that the sellers are getting tired. And if you like divergence, you're going to love this next one. It's an even stronger confirmation signal called a failure swing. In fact, the guy who invented the RSI thought this was one of the strongest signals of a major trend change, period. Okay, so let me walk you through it step by step for a bullish reversal. First, the RSI drops below 30 into that oversold zone. Second, it bounces back up, creating a little peak. Third, and this is the most important part, it tries to dip again, but it fails. It can't even get back down below that 30 line. And finally, it breaks out above that first little peak it made. That breakout is the confirmation you're looking for that the trend might have just turned around. Okay, so we've got overbought, oversold, divergence, failure swings. You might be feeling pretty confident right now. But hold on, because this next point is probably the most important lesson of all. The RSI is not a solo artist. I'm going to say this as clearly as I can. You should never use the RSI by itself. Seriously, relying on just one indicator is a surefire way to get yourself into trouble. The RSI is an amazing tool, but it's just one tool in the toolbox. Its signals get so much more reliable when you use other tools to confirm them.
So who's on its team? Well, think about pairing it up with other indicators. Maybe you wait for a MACD crossover to give you the green light on an RSI signal. Or you could use a simple moving average to tell you what the main trend is, like only taking buy signals when the price is above the 200-day average. Oh, and an oversold RSI signal right when the price is hitting a major support level. Now that is a much stronger setup.
Whew! Okay, that was a lot. We went from the very basics all the way to some pretty advanced stuff. So let's just boil it all down to the key takeaways you absolutely need to remember.
So, if you remember anything from today, remember this. 1. RSI is a momentum meter. It's all about the speed and strength of price changes. 2. Above 70 is overbought, below 30 is oversold. But always, always remember that context is king. 3. Divergence, when the price and RSI are telling you different things, can be a powerful clue about where things are headed next. And 4. The golden rule, never, ever use it alone.
So now, the next time you see that squiggly line on a chart, you won't just see a random line. You'll see a story about momentum. But it leaves us with one last bigger question, doesn't it? While the RSI is fantastic for measuring that momentum is shifting, it can't tell you why it's shifting. What's the news? What's the earnings report? What are the real-world things that are actually driving that price? And that right there is the next level of the puzzle. Thanks for joining me.